You have 3 voicemails.
Currently, you see that the housing market in Vietnam is very heated, and these are mainly driven by speculators and fake waves. What do you call fake waves?
To be honest, right, I have to be honest here. I understood only 50% of what you've just said. You touch on that point where retirement, and you said you should not retire. Or I don't get that, because I'm looking forward for retirement.
Hello there.
Welcome to the show where we have the convos about Vietnam, you know.
Hello there and welcome to Convo Comrades, a conversation with the community about Vietnam. We've got a super interesting guest today because his name is Andy. Now, for some of you, you might know Andy from my channel, and you might know Andy as this really bubbly and carefree guy. But little do you know that he's actually a serial investor in the background. And that's why we've got Andy here on the podcast today to share with us his passion and his hobby in investing. Hello, Andy.
Hi.
Hi guys.
No, Long, you're not Andy.
Hello, Andy. I want to say hello to Andy too. Hello, Andy.
Hi Long, and is that Ray or Hio? How do people call you?
Hio is fine.
Okay, Hio.
Okay, so can you spend a bit of time to introduce yourself?
Yeah, so first of all, thanks for having me today on your podcast episode. And so my background in short, I was born and raised in the Czech Republic. And then came to the UK for uni, did my bachelor degree in Warwick and my master degree in Imperial College. And during those 2 uni years, or rather 4, I had 2 internships in investment banking at BDA Partners and HSBC, tried out management consulting after uni at Deloitte, but quickly realized that it wasn't for me. So I found my way into the investment world, real estate more specifically, and which is what I've been doing for the past 2 years. Mm-hmm. And just been loving it. So on the side, I also personally invested into 2 properties so far. So I bought my first home in London last year and currently closing one in Prague.
Congrats.
I'm now also venturing out to the venture capital space to keep myself up to date with the latest disruptive tech trends and startups, because that's also an area that I'm very passionate about. So I'm actually doing a side project with a VC fund based in New York where I support the partners in building out their syndicate arms. And you might think that, it's so not related to real estate, but I think it does complement what I do at Fora. It allows me to apply lessons learned from various industries and businesses, apply analogical thinking to potentially solve business problems in the completely unrelated industries like real estate. It helps with analogical thinking, as I said, and develop this big picture mindset, the ability to connect the dots between different industries and, see the points of convergence between different industries and trends.
All right, Long, before we continue, I have so many jokes that I want to pull right now. I don't know which ones to use now.
What jokes?
So for example, okay, Andy, you've got the job. Congratulations. That's the first joke. You guys are not laughing. All right. Let's move on.
I don't understand this joke.
Because it seems like he's answering an interview question. Shit got so serious all of a sudden.
To be honest, right, I have to be honest here. I understood only 50% of what you've just said. I understood completely when you were in Warwick University. That's fine, because I've done that. But then when you talked about VCs and some sort of complex words, then I zone out a little bit. But I guess that's the purpose of this episode, right? You're gonna teach me, and you're gonna teach all of us what sort of these things are.
All right. Well, no, that's really good. Hopefully, Andy can share some of his experience and shed a light on some of these areas and issues so that we can all know more about the area of investing and personal money management. And obviously, as you can all hear, Andy prepared his intro very thoroughly. Thank you very much for that. And he was definitely not reading off the screen, I'm sure.
Yeah, no pauses, no whatever. It's like
Yeah.
to the word.
Yeah, no ums, no ahs. Yeah, Long didn't have to edit that part out. Okay.
I know I saved you guys time, so
Yeah.
that's why I prepared so well.
Okay.
You
All right. Before we continue with the content of the podcast, I just want to provide 2 disclaimers here. Okay. So the first disclaimer is, so I've known Andy for like 6 or 7 years now, and the following conversation is going to be very reflective of how I talk to Andy, but also how I'm sorry, Long. How Long,
Racist.
how Tong looks to Andy. How Long talks to Andy as well. So we've known each other for a couple of years now. The personality of Andy and me specifically are of 2 spectrums. Okay, Andy is very excited about things that are new, that are upcoming. He gets hyped a lot around new things and new ideas, okay? So keep that in mind, bear that in mind. And when he talks about new concepts, he gets really excited about it to the point it sometimes is over optimistic. That's my view. And I tend to be the person who sort of brings a more reality lens to it, who questions things and who becomes more critical. So you might see that dynamic play out in this podcast. And so when we're talking about investments and investment opportunities and investment areas, bear in mind that those are our personalities, okay? And investments always carry risks. So be cautious of how the idea is being presented in this podcast. So that's the first disclaimer. The second disclaimer is that, well, just generally, this podcast is not meant to be providing you investment advice and financial advice whatsoever. We're not certified and we don't hope to be certified in that area. We're only sharing our experience. So please be very mindful of what you're investing in and where you put your money. And we'll talk about some of the investment and money management in principles later in the podcast. So things like, Long hyping up Bitcoin so that you guys buy so that the price increases. Don't listen to that. Remember to do your own research.
That's right. And, not financial advice. This is purely for educational and entertainment purposes. I love entertainment.
Purely for entertainment purposes.
Okay.
So let's dive right in.
Cool.
Why don't you share with us, why have you started this journey in investing?
I started my journey in investing. So I began my career in real estate, actually. And the reason why, I enjoy this particular sector so much is, number one, over the last 2 centuries, about 90% of the world millionaires have been created by investing in real estate. For an average investor, real estate is a great way for you to build wealth. And it's not rocket science, so everyone can build wealth out of it. And then over 80% of the properties increase value over time. Like, land resource is always limited on this planet. And as population grows, there will be more demand for real estate. And so that's why, I started to move into real estate. And also my family does a lot of businesses in real estate. So, I've always been seeing them doing that growing up. So it's always an area that I wanted to try out myself and, have it as my career. And number 2, it's also an exciting time to, be in this particular industries, especially, especially due to the rise of tech and the rise of new business models that is transforming how real estate is being consumed. So it's no longer like bricks and mortar business, as I said before. It's now more of like a product business. And so that's why it's so interesting. And that's why, I decided to start a career in this. And on the side, I invest also in various other things. And it's just a way for me to build wealth. And also to learn about different areas and, build my knowledge on different areas.
So real estate is your core. You started with real estate and then you learn more about other alternative ways of investment. Am I right in saying that?
Exactly.
And what fundamentally drives this need to build your wealth?
I think for everyone, it's all about stability. If you've seen this hierarchy of needs by the Maslow, safety needs, and, is always like at the bottom of the hierarchy. It's like a need. It's not even a want, to the stability in life. And it's just a way for me to meet that need in life, to achieve, my minimum benchmark of what I call financial stability for me. And also the second thing is, it gives me the opportunity to learn about different areas. Because, when you invest in different businesses, you actually learn about different businesses, industries. And, that's what valuable. That helps my learning and developments. And so, it's
okay,
and in general, I'm just curious about different things. So, investing really exposed me to various industries, various knowledge areas, and learn about different businesses.
So you started with a need, right? A stability need. I need to get to this level of stability. And then on the way of achieving that, you develop a passion for, okay, I actually can learn more. And on top of stability, maybe I'll become a millionaire, like you said.
No, I wouldn't go there yet, but yeah, that's the dream for everyone, right?
Yes, that's my dream. Let's talk about why people should invest, right? Let's say I have a job now. I earn my salary. What if I don't invest? I just live off my salary. Isn't that nice? I have my pension.
Yeah. Yeah, okay. So investing just simply means putting your money at work and then spend it on assets in the hopes of making more money out of it. It's a great way to build your wealth. And as I said before, it's a great way for you to, achieve financial stability, like earn more than, than just your salary and build towards your, I'd say, retirement life. Although I really, really don't like this word because I think, like once you get into the mindset of making money, retirement should be the last thing you think about, or, you should never retire. And there's always some level of risk associated with investing. And the risks vary depending on where you put your money. It's a great way to build wealth, basically. Yeah, and so on top of that, as Ray Dalio, a famous American billionaire investor, which you probably know, has said before, that cash is trash. And that's why you're better off investing your cash than holding on to it for your dear life. And the reason for that is that money over time will lose value. And a simple hypothetical example to illustrate my point here is, let's say there are $9 being circulated around the economy. I hold $3. Each of you hold $3. Then the government suddenly decide to print another $2 and give it to Long.
Oh, yes.
And he now has the buying power to bid higher prices for all the goods in the economy compared to you and I. And then he can even buy up all the goods, which cause scarcity in the economy, which then pushes up the price even further of all the goods. And then you and I now have less purchasing power. So we kept £3 as cash. So if we kept £3 as cash over time, we'd be worse off. But if we invested those £3 with the hopes of increasing our wealth over time, then we'd be way better off, as potentially that £3 could grow into £5 or even more, so that, like when price inflate, or, from £3 to £5, we'd have more purchasing power, which is more in line with the economy.
Well, the value's already increased because we got $3 and now it became £3. So
So, right, the idea of it is you put money into an asset, and as that asset got inflated due to inflation, you're riding inflation, right? You're not stuck with your same old boring dollars.
Exactly, because these central banks print monies, and that's why, like Bitcoin is good for you. And I'll explain it for you.
Moon.
Yes,
no,
moon.
Sun. All right, why don't people invest then?
So I think it depends on, like who you're talking to. I guess, different people will have their different reasoning behind why they don't invest. But a lot of people are probably they're scared of taking that risk to invest their money into, like different assets, different investments. But, what they're unaware of is that different assets have different risk level. And, it's all about managing your risk. And that's what investment is all about.
You touch on that point where retirement, and you said you should not retire. Or I don't get that, because I'm looking forward for retirement subsequently. So when you say you should not retire, what do you mean? Like,
Long's sad. Long's gonna have to work for his life.
Okay, so I guess this concept of FIRE, right?
Yeah.
Financial independence and retire early.
Yeah.
That's never a definition of retirement for me, and in fact, I think that almost everyone that achieves financial independence and retire early still choose to work after their retirement. It's all about like this mindset. And then also, I have my dad who's already retired, and he did no work for 2 years, and I've seen how it's like to live that kind of life. It's actually pretty boring, and it numbs your mind basically, and it could be detrimental to your mental health. What I think is that a healthy way to approach this concept is to place more emphasis on financial independence rather than retiring. right? The aim should be to have more control over your life, and different people can have different approach to this, but in the end, it's all about what are the few things that are most important for you in life and what really makes you happy, and then spend on those, deprioritize the rest. Once you get into this mindset of, building your wealth, I think, like it's just never stops. You're always striving to want something more. It's not just about money, but it's also about your learning, your development, your personal development. And, I'm just very against the concept of retiring, because it just means that you stop progressing in life. It's
Really?
Yeah, it's like the end.
You sure? You sure about that?
Yeah. So, I'd love to have like a 4-hour work week, right? But just not completely retiring like my dad.
What do you think about the fact that it's boring because your passion is in making money and growing your wealth, and that's why you find it boring? But let's say if, another person, their passion is in learning new arts. And once they retire, they have the opportunity to learn new areas of arts and they love it.
That's a good point. Yeah. But then, at the same time, I think, if that's what they're passionate about, why can they not start now, right? Like they can always start their passion at the moment. And
that's a different story altogether. That's a different topic. That's on passion and leaving your job and doing what you love. But on the area of retirement, I mean, I just think that, sometimes people don't necessarily have the opportunity to do the work that they're passionate about. And retirement is the opportunity for them to start picking up new things that they hadn't had the opportunity earlier in life to do so. To you, I guess in a way you're fortunate because what you're doing at the moment is your area of passion, growing wealth. And that's why when you retire, you don't necessarily want to lose that.
Yeah, that I agree. Yeah.
So
Perhaps.
Investing will help you retire early so you could do the things that you're passionate about, in a sense. And investing is a very effective tool at that. You build your wealth, generate income, passive income. So to me, right, can I get a reality check? For me, why I invest is number one, to protect myself against inflation. All right. So, inflation, money lose value over time. Right. And if I just have money, I lose value of money. So I have less spending power. If I invest in some stock, I might preserve that value of money. So that's the number one purpose for me to invest. And number two is I also hope that the value of my assets will rise in that long-term horizon, maybe 10, 20 years. It will give me some cash flow for me to enjoy. That's my thinking of investment. Is that good?
Yeah, I think that's fair. And it's exactly, like why you invest, right? To basically hedge yourself against inflation. And, that's a great point to make.
Oh, thank you. Thank you.
Wait, so just going back slightly to the previous conversation here, you mentioned that your dad wasn't feeling happy. Is that your interpretation, or did he share something with you?
No, so, me and him, we chat a lot. And, he got to the point where, it's actually really boring for him. Just, like completely retired and, golfing every day. And so now he actually went to Vietnam and, he found like businesses there. And now he enjoyed it so much more that, he's back to work. It helps. Because retiring, as I said, numbs your mind. So
it needs some stimulus.
Cool.
I wanted to ask about what are the risk of investing, because I worry about risk.
Yeah, so you have to, when you invest, you have to be willing to risk all of your money. And for certain assets, it might be less risky than others, but there's still this, no matter how small, there's still chance of losing all of your money. So that's the risk that you have to bear in mind. Like the market is constantly changing. Whatever you invest in could be affected by macroeconomic factor, political factors. Companies might go bankrupt if you invest in stocks. There's always a downside to investing in. So there's always an element of risk that you have to be aware of.
Cool. Okay, so you talked about the FIRE concept. Let's talk about the other concepts then. So you touched on investing. What's the difference between investing and trading?
Yeah, so the distinction between investing and trading is really easy to make. When things come very blurry is when you compare these two with gambling, but I can touch on that later. Mm-hmm. So investing is basically a long-term approach with a goal to build your wealth over an extended period of time. Mm-hmm. Basically by building up the assets, and what assets really mean, if you learned accounting and finance before, an asset is what would generate you future benefits. whereas
Okay.
the liabilities, it decrease your future benefits. That's just a simple way of like looking at it. And trading, on the other hand, is more of a short-term strategy to maximize your returns. Either it could be daily, it could be weekly, it could be monthly, it could be quarterly, by basically
Yearly,
buying.
decadely. So where is the line between investing and trading then?
So I think it's like trading is more of like when you think monthly, quarterly, and daily. Investing when you think in terms of years, right? And in trading, transactions that are involved are so much more frequent. Whereas when you invest, you hold it for your dear life, or what the Wall Street bets would call it, like HODL, HODL.
Okay, and how are those different to gambling then?
Let's make a distinction between trading and gambling, because those two are very similar, and it can be even the same thing, right? Some traders are gambling without even.
Long, listen up, okay? Long is doing some trading in the background. All right, Long, listen up.
Okay, and then some traders are
Actually,
gambling.
not even Long, Lan as well. Listen up to prevent Long. All right, sorry, go ahead.
Yeah, no. So what I want to say is that some traders even gamble without even knowing. And this is a trap that a lot of people falls into. And the difference between the two lies in the mindset that you have when you place a trade. So, for example, when you gamble, right, you bet your heart against the odds. You're putting money into something that might happen. You might do some, probabilistic calculation on your head, and
That's
make
right.
decisions on it, right? But here, when you gamble, you care about the outcome. You don't care about the process. All you care is like looking at that outcome and see what probability that might plays out for you, and you bet against the odd. And in trading, you try to minimize your risk and maximize your profits. And the difference between the two is all about money management. When you're betting, you are basically just betting on the outcome, as I said. And when you're trading, you think of the entire process and series of scenarios that lead to the outcome. You're doing it in a methodical way. So, for example, you buy a stock for $10 because you think there's a probability that it will go up to $12. Or you short sell a stock at $10 because you think there's a probability that it could go down to $8, for example. And to me, that's that's gambling. And now think of this different scenario, right? You are extremely alarmed of the impact of COVID-19 on the economy and companies' performance. But you still want to buy the stock because you don't want to wait and miss out, right? Because who knows, what's going to happen to the market tomorrow. No one can tell the future. We're not fortune tellers. So the stock market had dropped 15%, and it could drop much more. And it could go up again tomorrow. You don't know. So you decide to buy the stock because you think that there's a high chance that vaccine will be rolled out next month, for example. The stock market will go up again. You have a good investment thesis for this. But then, you know that there is still downside risk to it, right? And it's all about managing this risk. So you may choose to hedge yourself to limit the risk. And you do so by buying a bunch of credit default swaps contracts, for example. And a simple way to explain, what this really is basically you're buying an insurance against the default risk by a particular company. So if the market, let's say, declines, and the companies that you invest go bankrupt, your portfolio would be protected by this insurance. And there's also another upside to this, which is that, as the market worsen, these insurance contracts become more valuable. More people would be demanding for it. And so, bidding the price higher up, and it become more expensive. And, what happens is that you might decide to resell a portion of this insurance, take out some of the profits. So, this whole process of thinking about it and, how you minimize the risk, that's what trading really is. Whereas when you only think of the outcome, what might plays out, that's more of like gambling.
From what I've understood from your explanation, it seems like gambling is a very pinpointed tactical action, and trading is something that's a bit more strategic, and it requires a number of, or a portfolio of actions combined in order to bring together a cohesive trading strategy.
Exactly.
It's not just the action of buying and selling stocks, but also how we manage that risk altogether by doing other actions. For example, you said there buying some sort of insurance. Are you saying that?
Yeah, exactly. That's exactly what I meant. And it's so, like I said, it's all about money management.
So to what extent is gambling a subset of trading then? You gamble and then you buy some insurance.
No, you can't do that. You can't do that.
Why? Why not? You use the same principles that you've just explained.
As I said before, it's the mindset that when you enter the trades. that distinguishes the difference. It's all the psychology behind it. It's like it's how you enter this mindset, of trading versus gambling.
Very fluffy. I don't, what do you mean by the mindset? I don't get it. Can you explain the mindset of someone who's trading a stock? Like what goes through their mind?
For example, when you enter stocks, if you look at these charts and like technical analysis charts, I think it's completely BS. And that's something that
Long's been reading up so much on technical analysis.
No, because I spent 2 years of my uni life wasting my time on this thing.
Long. That's not helping Long at all.
And I actually lost a lot of money. And I learned life the hard way, right? I'm completely honest here. I learned life the hard way. It's so hard to beat the market. So if you look at this, you just look at the charts, identify the patterns, looking at how historical price, predict the future price. The chance is 50-50. When you place your bet on like 50% chance, that's just gambling. And whereas when you trade, you think about the steps, you think about the whole process, how you think about different scenarios and how you minimize the risk for different scenarios.
What you've just said just now is completely applicable to a professional gambler who plays poker, who goes to the casino, who plays their moves and to think of different scenarios in order to make money. Gambling in a casino setting, it's the same thing. I'm still trying to find a difference. Or unless Long, you found difference, and I'm being a bit slow here.
I actually think poker players and traders kind of resemble very similar because they do a lot of calculations in their mind.
Exactly, I agree. I completely agree.
So gambling, trading is the same?
No. It's still not the same. It's all about, in poker, for example, you may de-risk yourself by, like minimizing your bets. Or, the way how you play out for different hands, the amount of stake that you put at hands, that's how you minimize the risk.
Yeah.
You don't have these different derivatives in trading, like that you can think about, you don't have these different techniques. You can manage the risk. But I do get what you mean. Like when I think about gambling, to me, it's less of, even like playing pokers. Because I think if you're a professional player, that could be a profession. But, when you speak to like an ordinary person and when you say that, that person, for example, Long gambles, then, I think like, okay, he doesn't really think about risk management. And that's the definition of gambling for me.
Yeah. Look, yeah, I agree. And I think there's a sliding spectrum here, isn't there, for both gambling and trading. The more methodical, the more professional, the more analytical you get in gambling, then that aligns yourself more to trading. And of course, the more amateur you are in trading, then that associates yourself more with the traditional quote unquote gambling concept. So it's a sliding spectrum. I don't think there is a fine line, like a clear line, black and white between the two. There's a lot of gray area.
And to give you guys a little bit of context, where we were laughing a little bit earlier when Andy said technical analysis is total BS. I am very interested in technical analysis because to me the main difference between trading and gambling is context.
Yeah.
You have historical data, whereas in gambling depends on the game. Poker, you have context. Poker, you have what has happened, and you can calculate what's gonna happen. But in some games you cannot. And with trading, you see previous price actions, and then that gives you a sense of what might happen next, because so many people will apply the same knowledge. So if many people apply the same knowledge, I think it will become true.
But would you say that, Long? It's kind of like chess, isn't it? Because, I'm bringing chess in here, but, every game of chess is on its own, but then you would have a lot of different scenarios of how to play chess.
Yes.
And that's your historical data. Similar to poker, I'm assuming there'll be tons of different scenarios. And then in each game, there'll be so many different rounds, right? So each previous round would be your historical data. So yeah, to me, the difference between these two concepts is a blurry one. And, people always tell themselves that they're not gamblers, they're investors, they're traders, so on and so forth. It's not that clear. I think it's not that simple. Just put it that way.
Yeah, you need to be an expert in each of these fields to be able to make good money. It's hard. It's very hard, I agree.
Okay, so since you touched on technical analysis in trading, can you just expand on that? What is technical analysis on trading?
So the simple way to explain technical analysis is just looking at charts and looking at the price patterns, looking at, historical price and predict the future based on that. And that's why, I think although, people never learn from their mistakes, but there are always moments in the market where new things comes in, and that's when your entire position can completely be wiped out if you just basically predict the future based on historical prices. It can take years to build up your wealth, but it takes one day to basically tear down the entire empire. If you are into that kind of mindset, like completely trusting the historical trends and predicting the future based on historical trends.
Mm-hmm.
But if you incorporate money management, right? Like you said, knowing your risk and then hedge against that risk. So, for example, you expect prices to go up, but it did not. So you put a stop loss. A stop loss is just you agree to sell at a loss, but at a much smaller loss than if the market jumps straight down to zero, for example, right? You have a stop loss in, so that protects yourself from the downside risk. I mean, there's always probabilities and everything. And I'm not saying that trading is good for everyone, but I'm just saying money management is good for everyone. Yes.
Yes, exactly. And even if you put a stop loss, you can still lose money, right? I just think like, why don't you just invest long term and just it saves you the hassle of like thinking short term and have to go through all these psychological kind of panic attacks, right? Like as the market moves up and down. When investing, I think it's all about thinking long term. That's my principle of investing. If you want to touch the principle of investing, it's about thinking big, thinking investing in things that actually change your life. The little pennies like that you earn each day from trading that make no difference to your life, but risk yourself a lot more from losing. That's just not worth the bet, I think. But different people have different opinions on this, and that's just my personal opinion.
Okay. Another concept that I want to talk about is FOMO. What does FOMO mean?
Yeah, FOMO stands for basically fear of missing out. So, and I think FOMO is real. People fear to miss out on things. So, like they just put their money without even thinking, just because they fear that they would miss out on huge opportunity. You might decide that there are a lot of hypes around Bitcoin at the moment, right? But you don't do your research on it. You don't really know the stuff inside out. You just fear that you would miss out in the end. So you put your money into Bitcoin without even understanding the technology behind it, without even understanding, the potential of it, without even understanding, what it is used for, or what purpose does it serve.
Do you need to know that?
Oh, well, yeah, because it defines, like its potential future. It defines, like where the cryptocurrency could be heading. Because it's used as it's a fee that people pay for their Bitcoin transactions.
Yeah, I guess I'm not really asking about Bitcoin specifically. I'm asking about the fundamentals of, do we actually need to know about Bitcoin or stock or bonds, etc., if it's already proven that thousands and thousands and thousands or even millions of people put their money into it? So why don't I just do it? I piggyback off the understanding and the learnings of others. I don't even need to do it myself. Do I need to know?
Yeah, of course. Like, you can never trust other people. If everyone thinks the same way as you, then everyone might be investing into a wrong thing without even knowing. And then in the end, who get out the first will be the one who, like pocket everything. And the last one will be the loser. And you don't want to have even like the smallest chance, right, of being this last one to get out of the market and lose everything. As I said before, it takes time to build an entire empire, but it can take one day or 1 second to, just completely get it wiped out. Just by making like a small mistakes. And this is something that you can avoid. So why not avoiding it, right? Why not do your research on your own instead of trusting others, and have your own points of view on an investment that you decide to make?
I agree. And I think there is a sliding scale in terms of how much preparation that you need to do, but also making sure that you're in at the right time. Because if you're dying because of what's that term? Paralysis from analysis, right? You're doing too much analysis, you're not actioning, then that's also not good for you. But you need to be careful of FOMO and fear of missing out, because if you're just putting money blindly into something that you think you see a lot of other people are doing, and you're jumping on the bandwagon without doing much analysis at all, that also can be detrimental to your investment.
I agree, and it's this mindset that like long term, the mindset of FOMO. If you get into this habit long term, you could easily lose your money. And completely agree with what you say.
And if you adopt the principle of invest what you're willing to lose, then in the case that you lose, not gonna be a big impact on your life.
No, people always say that, but then when they lose, they're like, oh, shit.
Well, of course you're going to have an emotional reaction. You're not a robot, but at least you've already braced yourself for it. It's all about expectation. Happiness comes from expectation, to be honest.
I agree.
Yeah.
And sometimes it's about setting real expectation instead of a unrealistic one.
Cool. Interesting, because you touched on money management. So let's go through some of the types of investments and types of ways that you can manage your money. We've got a number of different types here. Savings account. What do you think about that? Can you explain what savings accounts are and why people should put their money in and why people shouldn't?
So putting your money in a bank account, it's safe unless the bank go bankrupt. It's pretty safe in the UK and the US, or in the Western countries where people place a lot of trust in these banks, or they have high credibility. That they wouldn't go out of business any soon. You put in these banks where they are too big to fail, and you earn a safe interest out of it. But it's in the UK and US now, you probably earn 1.5%. I don't know.
In Vietnam, when you put your money in your bank account, then you get 8% return, is it?
Oh yeah, that's true. That's crazy. Yeah.
You guys said 8% savings rate in Vietnam.
Yes.
Or even higher.
That's Vietnam dong, right? Because the government wants to promote Vietnam dong. So if you put USD, for example, in the bank account in Vietnam, you get 0%. In some cases, 0% interest. But if you put Vietnam dong, you have 8%.
One of the reason why, it's because of inflation. It's all linked with inflation. Inflation in Vietnam is crazy. Every year is crazy. Imagine, I don't even know how much it is, but I just know that, the value of the money depreciate over time so much, so fast, in Vietnam. And so if you earn 2 or 3%, in Vietnam, it just wouldn't make sense to put your money into a saving account because inflation would probably be more.
Can you briefly explain to everyone the correlation or the dynamic between inflation and interest rates?
Yeah, so the easy way to think about it is when you think that, the economy is, in the booming stage, right? People spend a lot. And what inflation means is there'll be more demands for good. There'll be more investment made, and this pushes up the prices up. As the price goes up, the central banks, who controls the money printing, would have to control the inflation somehow. And they would do so by contracting their monetary policy. What it means is basically they could, for example, increase the interest rates to discourage spending, to reduce inflation. But, in economies where, where people encourage spending, keep the interest rate low, that encourages more spending, more investments, and therefore lead to inflation. That's just a simple way of thinking about it.
What is so bad about inflation? If price rise, we print more money. That's it. Okay, if a cup of coffee instead of 5,000 dong is now 10,000 dong, fine.
But it creates inequality, right? People print more money, but it doesn't always get equally distributed to everyone in the society, and I think that's why it's bad. And with inflation, you can buy something for £5 today, but inflation goes up to £10 tomorrow. You lose your purchasing power, and those who doesn't have access to these new money that gets printed would lose the most.
Okay, cool. Stocks and bonds then. So why should people invest in stocks?
So a stock is it's a type of security, and when you own a stock, when people say they own a stock, you're basically owning a portion of a company. And then depending on the company's performance, the wider industry performance, and the macro environments, the stock can go up and down in price. And there are a lot of factors that can affect stock price, and there are a lot of materials that you can read about this on Google.
So if an average 20-year-old or 25-year-old in Vietnam at the moment wants to get into stock investment, what do they have to think about?
I really do think that, picking stocks is really hard. It's hard to beat the market because there's always professionals out there who's, doing this as their job, basically. They get paid and they're really good at this. And so, picking stocks that is underpriced you're always, if you're like individual investors without, like these knowledge, without access to information, you'll always be the last, to get into the market when the price is already so high. And so you have to be aware of that. You have to be aware of, like that you could be risking your money. The company could go bankrupt. Be aware of all the risk. And you must really know your thing inside out. You must know the company inside out before you invest in stocks. Know your ass before you, put money into anything.
From what you've just said, you need to know the company inside out. Is it by working for the company? you need to go inside that company.
No. So there are a lot of, like public companies that are traded on like the public exchange. They post financial reports online. There's a lot of information that you could read around the news. And, they disclose a lot of like financial information annually, quarterly, half a year. They post these financial accounts that you can have a look into. So all I want to say is that, do your due diligence on the company before you invest in a company.
What's due diligence? I mean, this word is being used a lot. What does it mean?
Yeah, so it basically means, like know the company inside out. It could be know what they do, know their financials, the history of the company, how they've evolved over time, the management, how the management gets paid, all elements of a company, in order for you to assess risks and assess the future performance of the company, the potential, growth trajectory, and, what could go wrong with the company. Any kind of information that could help you assess these risks and analyze, what you determine to be the intrinsic value for the company, and compare it, what the market is valuing it. If it's undervalued, you might as well, enter the stock. Basically, you invest into the stock. If after doing your due diligence and analysis, you think that the stock is overpriced, you might decide not to invest.
So essentially, you look at a company, you see whether it's doing well or not, and then more importantly, you see whether it has the potential to do even better. And then you see what are the risks associated to buying a portion of that company. If you feel like you can handle that risk and you feel that there is upside potential for the company to grow even further, which equates to your stock being of higher value in the future, that's when you decide to buy a portion of that company in hopes that that portion will grow as well together with the company, right?
Exactly. That's a good way of thinking about it.
You've just explained the process, and obviously it takes a lot of time, and not everyone has the time, and also, let's be real, the skills to do that as well. So if someone wants to get involved in this but not necessarily have the skills, what do they have to do? Do they have to go through a broker, or do they have to buy funds, or what?
There's this thing called ETFs, which every ordinary investors, and especially those with little knowledge about stocks, I think should put their money into, rather than picking individual stocks. And ETFs stand for, what it is basically exchange traded funds. And these are public funds that are traded on the exchange. So you can buy it on any kind of exchange. Just go to an investment platform and buy these index, like the S&P 500 in the US or the FTSE 100 in the UK, for example.
What are these, Andy? Are they a combination of the different stocks of the different companies in that portfolio, or what are they? What are ETFs?
Yeah, exactly. So they basically track the wider stock markets. And owning these ETFs would mean that your risk is diversified into multiple companies. So, there are different types of ETFs. But for example, the FTSE 100, it's basically a portfolio of the top 100 company in the UK. And when you invest into these ETF, FTSE 100, you're basically buying, think of it like someone creates a pot, put different companies into that pot, and the pot has a value, and then it can have a number of owners of the pot. And so, when you invest in these ETF, you're buying a portion of this pot of different companies, and you jointly own the companies in this pot.
So you still own the company, right? Are you buying the pot, or are you buying the money within the pot, or the stock within the pot? Because there's a difference.
Yeah, so you're basically buying the pot. So basically, these ETF funds, they invest into multiple companies. They have a diversified portfolio of companies, and basically their price on the stock markets reflects the performance of all these diversified companies, all these stocks jointly together, averaging out.
Would you consider yourself an investor then of 100 of these companies if you buy an ETF?
No, you wouldn't be.
So you're not really a stock owner per se. You're someone who owns the ETF, which tracks the stock.
And the ETFs can own the stock, but you don't actually own the stock yourself personally.
I guess what I'm trying to say is, what is the difference between me obviously the time is the main difference, right? But let's say I have the time, I buy 100 stocks from 100 different companies compared to me buying an ETF of the FTSE 100.
Yeah, there is. So, like these, when you buy these companies, you have a more direct ownership of these companies. When you buy an ETF, you are basically owning a portion of this ETF pot. And these ETFs, they own, they diversify their investment and they own these companies. So you have no say.
And voting rights, no voting rights.
Exactly.
You just expose yourself financially to these companies without, let's say, the hassle of owning the company.
Exactly. And also, also these ETFs, they might, reallocate or, update their portfolio on a weekly basis or on a monthly basis. You save yourself a hassle of, tracking and, reproportioning, different percentage of different stocks in your portfolio.
So these ETFs don't have a objective of making profit, right? Whatever is in the FTSE 100, for example, new companies goes in, this ETF will automatically sell the old company and buy the new company without a underlying objective of making more profit.
And when Long is saying new company here is like, the 101st company to become the 100th company. And then the 100th company moves down to become the 101st company.
Exactly. And then also, there are these ETFs, like, for example, ARK Invest. They invest, just purely to outperform the markets. So they think that, that they can beat the market. Their portfolio can beat the markets. And so they invest
What do you
purely
mean
for
by
profit.
beat the market here?
As Warren Buffett has said, the market on average, for the last 20 decades has earned around 7 to 8% returns for averaging out over the long term. When you beat the market, basically you think you can perform better than the wider market, better than 7 to 8% returns.
That's I can do that. I can just put money in my Vietnamese bank account, 9 or 10%. That's easy.
Yeah, but you own Vietnam Dong, which which loses your purchasing power.
Are you dissing our country's currency?
Best currency in the world.
Best currency in the world, yeah.
So when you say beat the market, you're saying someone who puts money in now and wait for 10 years versus someone who trades in and out throughout 10 years. And at the end of the 10th year, you compare. That's called beating the market, right? Let's see if the one who just hold and do nothing can win the ones who trade in and out to profit of fluctuations.
Exactly. When you think of the outcome, you have to think long term, like 10 to 20 years.
Or just like different ways of investing. It doesn't necessarily have to be investing versus trading. It can be like you're investing in two different portfolios, but then if the other portfolio is doing better over 10 years or X number of years and has a higher percentage of return, then you're beating that average market benchmark that Andy quoted from Warren Buffett.
I see.
Okay, so we talked about stocks. Let's talk about bonds then. What are bonds, Andy?
Ooh, bonds.
It's basically, when you think about like buying a bond, you're basically lending money for someone. And if you build, a living income stream with low risk bond, then you're definitely rich. Because buying government bonds or corporate bonds just basically means that you're lending money to the government or companies and earn an interest that is very low, right? So it yields like 3% or, even less than 3% in this current interest rate environment. And if I'm generous, for example, you might earn 3%, let's say a year. You need 4 million plus, in this kind of asset class to generate 120K a year. It's basically just lending money out to people, earn an interest, but it's less risky. So it does make sense to own some of the, you might as well, want to own some of the bonds just to diversify your risk investment.
Why is it less risky?
Bonds are always seen as less risky than stocks. If you're, for example, you can buy treasury yields. It's basically government bonds. And the US government, for example, never defaulted in the past. It might in the future, I don't know, but never default. So it's considered as safe. You're lending money to the government. That's the lowest risk kind of bond. Obviously, there are also like the junk bonds where it's highly risky. It could be as risky as stocks, but the bonds that I'm referring to here are like the safer ones. So like the government bonds.
When you said yield, it's like interest received annually, right? So
exactly.
If a bond has a yield of 3%, then you get 3% every year.
Mm-hmm.
Exactly.
What's the difference between that and just a savings account? You also get a percentage every year. Which is more risky?
So I don't actually own bonds, but I think that bonds actually yield higher returns than saving accounts, because obviously the returns what you get is proportional to the risk that you take. So higher risk, higher return, and bonds are higher risk than saving accounts. So you'd earn a bit more interest on investing into bonds. And then with bonds, the thing is that you cannot buy on public exchange. You have to go to a brokers for most type of bonds. And with the government bonds like treasury yields, you can buy directly from the government, but it's not available on public exchange.
I think there are two things to note as well. So the first one is just a classification of bonds. There are two types of bonds, aren't there? So you mentioned the government, but also there are corporate bonds as well.
Exactly.
I think the second thing here is linked to the risk aspect. Why bonds are relatively less risky than stocks is because, in the basic financial statement, right? Once you're going through all of your costs, etc., normally you would have to pay the debt before you pay the dividends. And when you pay the debt, in this case, your company's banks or your bondholders, you pay the debt first. So if the company goes bust afterwards, then the shareholders don't get the dividends. And that's why there's a higher risk.
Exactly. That bondholders always get paid first before shareholders. And then with bonds, there are different tranches where, different type of bondholders get paid before the others. But let's not go in there. It's a bit complicated.
Okay, so now we're going to the area that you're most fascinated about, Andy, properties.
Okay.
Can you break down property investing into structured categories for us to understand? What are the different types of property investments are there?
When you think of property, there are a few strategies, but I think the two main ones are build to rent or flipping. And number one, the build to rent, you might want, basically what it means that you might want to buy a flat as a long-term investment and generate rental income each month, which may cover your interest payments and spare you some extra cash if you're lucky. And then eventually the house is yours. And then long-term, you might decide to sell the house, gain some capital gain. But the point here is that you buy the house just so that you can get the rental income out of it. And then number two, flipping, is that when you decide to buy a property or that are, like undermanaged, that you think is undermanaged or need fixing, you flip it, which means that, you put some capital expenditure to make it all look old, nice and everything. You make it look more appealing to people. People want to pay more for it and rent it out, or basically just immediately sell it for profits.
Okay, so can you evaluate the pros and cons of each type of strategy then?
The pros and cons of each type of strategy is that, build to rent is obviously safer than flipping. Flipping involves more risk because basically you're buying an undermanaged house. You have to think of, like the cost that you have to put in and whether, like the potential value increase. You have to know your thing inside out. You have to know, like the markets. You have to, calculate your risk, calculate your cost, think of like the potential returns, how much you could, how much the value of the house could appreciate after you flip it and sell it. Whereas, build to rent is simple. You buy like always, like get like a house in like the nicest location, pick your location well, nice house. You don't need to put any capex on it. All you have to do is just rent it out for an income. It's much safer. Like you don't have to go through the hassle of fixing the house and spending much money on it. You might spend money on the furniture, but you don't have to spend a lot of capital expenditure on fixing the house. So it's obviously that's less risky.
Are you sure it's called build to rent?
Oh, no. So it's not build to rent. It's just basically
Buy to let.
buy to let.
Build to rent is like you build the whole thing from scratch and then you rent it out, right?
Yeah. My bad. It's too early in the morning, and it's buy to let, not build to rent. Yeah, buy to let.
And there's an issue about cash flow as well. Can you elaborate on that?
When you let, you have these monthly cash flows that flows into your pockets. So instead of, buying the house and immediately profiting it by, like take advantage of property value appreciation, for example, you would hold it long term, let it out. You get monthly rental income, and that's basically your cash flows. Cash flow is basically the income deducting all the expense. Whatever cash is left for you, that's the cash flow that you get that flows into your pockets.
Why is it important to have cash flow?
Just like how you like why it's important to earn a salary, right? It's basically to get more income that you can spend on different things in life. And
I guess there's a risk, isn't there, to the other option of selling the house. If you can't sell it in, I don't know how many years, you run the risk of not having cash and not having money essentially to spend on groceries or to buy anything to eat, right? So that's a risk.
But then if you can't sell a house, right, you can always rent it out. Like it's not like one way or another. If you can't sell it, you cannot rent it. Or if you rent it, you cannot sell it.
It's not mutually exclusive, but there are
Exactly.
times where they can be mutually exclusive. Sometimes, it's not really a place where someone wants to rent, for example, or the rental market isn't as healthy as you want it to be. And when you were purchasing the house, you had in mind that this is the type of house that you're able to sell instead.
You also have to think of from the buyer's perspective. Like if it's a market where you cannot rent, you cannot earn income, then you just limit, then, think it from the buyer perspective. If I'm a buyer, like who would want to go into that place? It's basically then it's a market of speculating, and we can talk about this because this happens a lot in Vietnam.
Not necessarily, because I guess sometimes if you want to sell it to a family, and families probably don't want to rent, right? So it might be a neighborhood where it's easier to sell the house rather than to rent it out.
Oh yeah. Then in this case, then that makes sense.
Yeah. Okay. Long. Any questions?
How can you find a good property for both, buy to let as well as flipping?
Yeah, so at a high level, I think location is everything for property. Talking about location, what I mean is, different factors that you may have to consider would be things like what's the crime rate in that location, for example, or what's the economic development within that local neighborhood, that area. How does it look like? What's the future potential? What, like are there any new developments coming up? Is the place going to be regenerated to become something, like much nicer, much bigger, or and then also look at, like when you dig down deeper into the property itself, you also look at things like, is it accessible? Like supermarkets, hospitals, all these amenities that are around. These are the things that people value, right? So when you invest in property and evaluate the location, you think from yourself as a consumer, like what would you value as someone who, would occupy or who would want to stay in this place, in this particular location.
I guess in more detail after that, the next steps would be to make sure that you wear the cap of the specific person that you're targeting, or type of person or persona that you're targeting, right? So if you're targeting students, then you start to hone in into, whether it's accessible to schools, to activity areas, to pubs, etc. If you're targeting small families, whether it's accessible to schools, probably primary school, not universities in this case. And then, other family-friendly neighborhoods and areas. So that's the next step following that. But I agree with what Andy just said in terms of the high-level areas that you need to consider.
And then when you go down into the details, you might also look at the building specs. So things like, like electricity, service charge, the electrical system of the entire building, more details into, the materials and things like that, basically to assess the quality of the building itself. And this is particularly important for commercial real estate, especially, like things like MEP. It's basically like electrical systems in the building. Can you get, a lot of air into the building, things like that, Is it sustainable? Are the building materials built on sustainable materials? These kind of things.
Okay. No, that's good. We're going to be touching on commercial real estate because that's your job later in the podcast. But now it's more personal money management. Shall we move on to peer lending then? So what's peer lending?
Okay, peer lending is basically a platform where, people can lend to another people. It facilitates these kind of transactions where, for example, if you want to lend to me, we can go on this platform. Just a simple way of thinking about it.
So kind of like a personal bond. You got corporate bond, you got government bond, and now you got a personal bond.
Yeah.
If you like to put it that way. So it enables people to lend money to businesses as well as individuals. So not just, individuals to individuals, but also individuals to businesses. And as a lender, you would receive an interest and, get your money back when the loan is repaid, just like how you do the normal lending and borrowing. And there are platforms like Peerberry, which I used before. Not anymore though.
Oh,
Uh,
really? Why?
Yeah, exactly. I'll tell you about that. But with this platform, even if the borrower default on their debt, you still get your principal amount repaid. It's guaranteed by the platform, and so it's pretty much riskless unless the platform goes bankrupt or go out of business. So the reason why I'm no longer using this. I used it before, but then decided that the returns of 9 to 11%. So with these platforms, you earn like around anywhere between 6 to 12%, depending on like your risk level. You can adjust your risk level on this platform, and lend to like more risky individuals or business, or like safer individuals and business. And 9 to 11% each year, for me, that wasn't attractive to me. And the second is that like I'd have to lock my investments for 30 to 60 days minimum. And for me personally, I place so much premium on liquidity, and so that's why I decided to stop and put my money elsewhere. And I'm also a risk taker, so the risk reward for this was just not attractive for me.
You were saying 9 to 11%. That's more than what Warren Buffett is saying. This is not something you like.
Exactly. No. That's why I said it's a personal preference. Like for me, I'm a risk lover. I'm like risk on kind of person. So I invest in much more risky investments, but yield higher returns, like cryptocurrency, Bitcoin.
Okay, so we're going to talk about those things later in the podcast. But why we're talking about peer lending is because a couple of months ago, Andy told me about this platform and the ability to just give money to random people and get a return. And there's all this sort of guarantee that the company provides. And I was very skeptical of it because when I looked up on the different companies that are, getting money from you and paying back gradually, these companies are all just like really small companies in East Europe, like in Lithuania, Poland, and whatnot. So the risk of default is huge. And I was just asking him all sorts of questions about this. He was hyping it up so much. I was asking him about, what happens if all these companies default? Who's going to pay the money? And then he says that the platform is going to pay you the principal back if a company defaults. Then where does the platform get the money then, if a company defaults in Poland or in Lithuania? And that's when I think that the platform's probably just going to use the money from other users of the platform to pay you instead. And that kind of spells to me as some sort of pyramid scheme, isn't it?
No, but then how would they, if they use the money of other people to pay you, how they make profit out of their business, right? They have to do proper lending to earn interest rate, and that's their income. Because, just by taking money from another individual, give it to another individual who also lends, like taking money from lenders and give it to another lender, that's not how you make income out of the lending business. And so, like they actually do lend money to like proper businesses, but it's just that I don't know what's happened behind the scene because I'm not in this business, but obviously they must do their own risk management and money management. And Peerberry is a pretty credible platform backed by a large financial institution. So nevertheless, there are a bit of risk there. If the company defaults, then you lose all your money.
Yeah, it's so savings accounts are still the safest, right? It's backed by the government.
So what's the equivalent of Peerberry in Vietnam then? I don't think there is a platform that provides that, right? It's more of just, hey, here's a stack of cash, take it and then give me the interest, or I'm going to come to your house and beat you up.
Loan sharks.
It's called pawn shop.
How does someone come into this market in Vietnam and provide some sort of assurance then? I don't understand, because the market, how do you evaluate companies' credit scores and the ability to be able to lend to them in a market like Vietnam, where it's so sporadic and everything's popping up left, right, and center?
That I'm not sure, to be honest, because I don't really live there to give you the answer, but I do think that there must be a system in place where people can do credit checks on you, credit checks on the companies, and assess the companies, just like how you do it like in the UK.
Yeah, well, they managed to do it in Lithuania and some Far East Europe country. That's probably a way to do it, huh?
Yeah.
Right, so let's try to wrap up the first part of the podcast then. So if you were to sum up, Andy, think about, a young, either graduate or working professional in Vietnam at the moment listening to this podcast, or Long's mum, if one of those people were to listen to the podcast at this point in time now, and they want to think about investing, what would be the key investment principles that you would want to share with them?
Yeah, so there are a lot, but the few important one for me, right? The first one would be invest with margin of safety. which means that, only buy undervalued stuff. And so that when the price significantly drops, you have a margin of safety to save yourself from like making losses. So buy assets that is priced significantly below the intrinsic value, like the fair value in the markets. And the second would be to think big. So if the potential of the investment that you make doesn't have much impact on your quality of life over the long term, then probably, it's not worth it. So choose investments that are scalable and has compounding effects.
For example?
So like investing in stocks, for example, that has compounding effect. Or, invest in long term. So making short-term trades, that would be like thinking small. Making short-term trades, like to earn, these penny profits on a daily or, weekly basis. That's like that's basically there's a higher chance of losing money than actually earning money. So, so think long term, basically. That's what I meant. Yeah. Why are you laughing? But yeah.
Every time you talk about trading, Long just cries a little bit.
Yeah.
No, but I mean, if you're a professional trader and if you're good at it, I don't see why not. Like,
That's a big
why you don't do it? Why you don't do it? But I'm speaking from the point of view from like ordinary investors and even me myself, who don't have that skills of a trader. If only do things or only invest in things that and it's best to like just have a simple strategy, invest in long term. For example, let's say if you invest and price might fluctuate in the short term, but if you put in the money, a consistent amount every month, over time, it doesn't matter how much the price fluctuates in the short term, it will average out, right? And over the long term, your investments will rise.
Good point.
So, and then the third is that always consider the worst case scenario. So always manage your risk and have an exit strategy for any kind of investments. And the last and also the most important principle would be to diversify your investments and de-risk your portfolio. So never concentrate your money in a few stock or cryptocurrency.
But you don't follow that. Well,
no, I do.
Screw peer lending. It's 9 to 10%. I don't like that.
No, so I still diversify, but
in highly risky.
Yeah, in different things. But even if I put money in highly risky assets, there are different sub assets that I diversify myself across.
Yeah,
right?
exactly. So you diversify in an area of super risk.
Like we can talk about it, but I don't think it's as risky as you think. Like if you know your things inside out, I don't think and you have a good investment thesis for it.
Okay. I'm so looking forward to that part of the podcast because we're gonna have a heated debate, 100%.
Are there any scams in investment?
There are a lot. Like, oh yeah. So think of the Vietnam markets, right? In real estate. This is, I spoke with my dad the other day and also my cousin the other day, and I learned that there's this kind of like scheme of fake information flying around. So currently you see that the housing market in Vietnam is very heated, especially in Hanoi, or, like in places where there are new planning submissions or large developments going on. Prices would just shoot to the moon in a blink of an eye, like really. Like, and these are mainly driven by speculators and fake waves, what you call fake waves. So a lot of investors lost money or being stuck or unable to escape from these waves. And what I mean by these fake waves is like the situation where brokers and sellers would create fake transactions among themselves or collude to create these fake transactions to establish a price benchmark for the whole area and then lure buyers into the ring. And they do this by using the network to create unreal demands. So say, like me and Long, we create fake transactions, exchange hands, exchange properties. And
so I'm the victim then. All right, I'll play the victim.
Okay. And then we use that, like that price, that fake demands to drive up the price in the markets. And then we create, then we create these fake information like scarcity. For example, like saying, marketing the house like, oh, there are only 2 houses or 2 lots left in this area, but there are many people who want to make deposits and these kind of BS, and I just keep it for you because I like you. It will be sold tomorrow. So if you don't decide now, it'll be sold, right? And then sellers would take the advantage of the lack of understanding and temptation for huge profits because that's wired in the mindset of, like Vietnamese people. And I can talk about this if you want. Like, where does this come from? Information about like plannings are so exaggerated to be dreamy outlook of the project area. But in reality, there are so many unrelated elements to make the area become busy and crowded, which people don't know. So it's a whole new world, like in Vietnam. Like there's a lot of misinformation flying around, and speculators take advantage of this, or like those who have money take advantage of this, those who have network take advantage of this to squeeze every pennies out of people who are uneducated. And so super interesting.
Dangerous place out there.
Exactly.
Thank you for the rant.
Do you have any steps people can take to avoid these sort of scams?
So just be aware of it, be aware of your market, be aware of your local area, speak to people, build your network, know your thing inside out.
Take it slow too, right?
Educate yourself on exactly. Take it slow and educate yourself on it. Don't just, go into the market. Don't just follow the hype, like the herd, and then just put your money without even, thinking of the risks, without thinking of, even considering all the information there are in the markets.
All right, I think this is a good place to end our first episode with our golden guest, Andy. Thank you, Andy, for sharing with us your journey into investing, taking the time to explain the concept of investing and many different types of investment and how to avoid scams. This is very, very insightful. On the next episode, we're gonna continue our conversation with different careers in investing and the future of investing. So thank you everyone for listening in. Join our community at Convo Comrades on YouTube, Spotify, and Apple Podcasts. As for now, bye-bye.